Good afternoon, everyone. Thanks for joining us for What Makes a Plan Qualified. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. At the end of the webinar, we would also like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will follow up with you afterwards. Tomorrow, you will receive an email with a link to replay today's broadcast. Today, we are joined by Dave Bearer, National Director of TPA Markets at Pentegra. Dave has over 30 years of experience in the financial services industry. His vast degree of knowledge and enjoyment for helping advisors better assist their clients and expand their practices has made him the go-to expert for 316 fiduciary outsourcing and TPA services. Dave, I'll hand things over to you.
Thank you, Noelle. And yes, everybody, that's her real name. It's not just a holiday gimmick. Happy holidays to everybody who's joining us. Today we're going to talk about what makes a plan qualified. And our learning objectives, and I'm going to do my best to insert information here and there. I will read what's on the screen for the benefit of all, but for the most part, I'll leave the reading to you, and I will insert color commentary as we go. So we want to be able to list the benefits of plan qualification, differentiate between prototype plans and custom plans, actually known as pre-approved plans and individually designed plans. We want to be able to demonstrate an understanding of plan provisions and what are mandated by law or regulation. We want to identify which plan provisions can be considered as optional and the implications of selecting each, list the various types of qualified plans and available features, and to demonstrate an understanding of the maximum contribution limits. That third one from the bottom there, identify plan provisions. Typical adoption agreement is in the neighborhood of 35 to 40 pages long with hundreds of different elections available. So we're obviously not going to go into depth on every single one of the plan provisions that can be considered, but we're going to talk about them in general. Plans must satisfy IRS rules to be qualified, and they must meet certain criteria. And of course, the reason we do this is not just to save for retirement, but we want contributions to be tax deductible and tax leveraged. Plan must be in a written format. Documents must conform to provisions of the Internal Revenue Service. Plan document language must be consistent with current laws and applications. I can't tell you how many times a day I'm involved with a consultation regarding a document that's not up to snuff. And so it's very important that documents be kept in good order. Operational compliance and testing requirements must be satisfied, and the reporting and disclosure requirements must be met. You're all probably familiar with Form 5500, which is filed on an annual basis for most plans, sometimes including an independent audit. And that's the reporting and disclosure, or the reporting requirements. There are also disclosure requirements that have to be distributed to participants, beneficiaries, and alternate payees. Not following the rules can result in loss of qualified status. Obviously, loss of qualified status would be a bad thing. Disqualification of a plan can cause contributions to revert and not be deductible by the employer. They can cause the account itself to not be tax benefiting. And think about too, when an employee, if an employee has an account that they hope someday to roll over to an IRA, well, if the If the plan is disqualified and the accounts are disqualified, then it can't roll to an IRA. Now, we all know the IRS in particular and the Department of Labor, they're not spending their time looking to disqualify plans. They're all about bringing plans into compliance. They're all about correcting employers that are not paying attention to the rules, and in the IRS's case, they're all about collecting penalties for non-compliant plans rather than disqualifying plans. But it's a risk that plans bear that we have to pay attention to. Plan document language must be up to date and correct. 401k plans, we recently went through a Cycle 3 restatement. Everybody probably remembers that. 403b plans, we went through a Cycle 1 and remedial amendment period that was the first ever, lasted from 2010 through midway through 2020. And we're looking at Cycle 4 for 401k plans in 5 years now, from 2023 going forward. And with 403b plans, we're looking at Cycle 2 in 2026. Plan language must be followed in actual operation. Let me hang on to for a moment about up to date. Everyone is familiar with Secure 2.0 and that language that came out. And something I can assure you of is that because we've already been told this by Treasury, is that the next two cycle periods, the 401k Cycle 4 and the 403b Cycle 2, neither of those will have Secure 2.0 language incorporated in those restatements. We will be living with amendments for the foreseeable future. So if we look at 6-year restatement cycles, we're going to be living with Secure 2.0 amendments until something in the neighborhood of 2029, and longer than that for 403b, because neither of the mandatory restatements will carry that language. Periodically updated, that's what we've mentioned. Those cycles come around now for volume submitter, what used to be called volume submitter, now just simply pre-approved documents. Individually designed documents can submit periodically. The IRS is very stingy with determination letters, D letters as we call them, for individually designed documents. We encourage the use of pre-approved documents. Changes in government rules may require plan amendments. When an employer wants to change something, we frequently have this happen. I want to change eligibility, or I want to change vesting, or I want to change something. So we change things in documents from time to time. Certain benefits are protected and can't be changed retroactively, but can be changed going forward. Some can't be changed at all. Keeping the document up to date is important. Here's our first polling question. Go ahead, Noelle.
All right, the first poll is open. Which of the following must a plan satisfy in order to receive tax preferred treatment? The poll will remain open for about 45 seconds. The poll will remain open for about 15 more seconds. The poll is now closed. The correct answer was D.
Thank you, Noelle. So, retirement plan qualification, very, very simply put, these plans, the the United States lives on an employer-based private pension system, if you will, private retirement plan system. And it provides tax benefits for that, and contributions are deductible. Plan document language must be up to date, and it's essential to instructing plan administrators how to operate a plan. And of course, the plan must be operated in accordance with that written instruments. ERISA Title I, plan must be operated in accordance with a written instrument, and so that's what we follow. ERISA mandates certain plan language. Certain things have to be in the document. The named fiduciaries, who is the plan sponsor, who is the plan administrator, who is the trustee, things like that. Funding procedures, how is the plan funded? Operation, administration, amendments, distribution procedures. How do you get money? How do you qualify to be in the plan? How do you put money into the plan? And how do you get money out of the plan? Assets in 401ks must be held in trust. 403bs are not subject to the trust rule because they were originally designed around annuities. Plan documents must spell out participant rights. These have to be communicated to participants. Documents must be set forth to appeal denial of plan benefits. So in other words, if a benefit is denied an active participant or their beneficiary or the alternate payee, they have to be able to appeal that denial. If Congress changes things, which Secure 2.0, Secure 1.0 for that matter, is evidence of that, then that's how things have to get updated. And so Congress, this is kind of a good slide. Congress set forth Secure 1.0 and Secure 2.0, and the IRS then adapt regulations, or will be adapting regulations, as to how to administer the law. So Congress passes laws, and the IRS, they set forth the rules by which we administer those laws. IRS and DOL do allow some flexibility. It's often said that ERISA is a very gray law. It's not always black and white. It is subject to interpretation in certain instances. Some things are very cut and dry, but employers have choices with certain plan provisions, and the choices are, of course, reflected in the plan document. Second polling question.
Okay,
I want you to get your credit.
Our second poll is now open. Who or what entities can require plan documents be amended? A, Congress and the President through law changes. B, the IRS and Department of Labor. C, plan sponsor. D, all the above. The poll will remain open for about 45 seconds. The poll will remain open for an additional 15 seconds. The poll is now closed. The correct answer was D.
Thank you, Noel. So the employer, the plan sponsor, gets to decide things. Who gets in? When do they get in? When do they participate? Statutory eligibility rules are typically a year of service, can be up to 2 years of service, age 21, 1,000 hours per year. Everyone's fairly familiar with that. We wanted to highlight here today Secure rules. We have new Secure 1.0 and Secure 2.0 rules. They go into effect very shortly here. The new part-time employee rules are what we call long-term part-time LTPT rules. And Secure 1.0, that came out in 2019, said that if a plan excluded employees from deferring their own money into the retirement plan based on service, based on that 1 year and 1,000 hours of service, then that was excluding a number of part-time employees from saving for retirement. So Secure 1.0 says that effective 1/1/24, plans must allow long-term part-time employees to defer their own money. They may continue to be excluded through various other rules, either hours of service or class exclusions from employer contributions, but they must be allowed to put their own money into the plan if they worked at least 500 hours of if 500 hours per year in three consecutive prior years. So beginning January 1st, 2024, if you have employees who worked 500 hours or more in 2021, 2022, and 2023, they must be allowed to defer if they're otherwise currently being excluded from deferring. Secure 2.0 shortens that to 2 out of the past 3 years. That change is effective 1/1/25. So we have this 1 year period where if you have employees who worked 500 hours or more in 3 consecutive years, beginning in 2024, they have to be allowed to defer. But by 2025, if those same employees have not worked 2 consecutive years out of the last 3 years, 500 hours or more, they can then be excluded again. Probably one of the things to consider as a plan sponsor is maybe we just let everybody defer into the plan if they want to, and we focus on exclusions related to employer contributions rather than employee deferrals. Exclusions, as I pointed out, to employer contributions, members of collective bargaining, exclusions to the long-term part-time are collective bargaining, non-resident aliens, and others defined in the document. Actually, I take that back. That has to do with employer contributions. So let's say an employer match or something like that. We can exclude members of collective bargaining, non-resident aliens. Other groups as defined in the document. You might have a company with multiple divisions, and it might say that Division B is excluded from employer matching contributions. And so long as the plan passes non-discrimination testing with Division B being excluded, then you can do that. So an employer also gets to decide about contribution types and different options about those types. So employee contributions, employer contributions, permitted disparity with employer contributions, profit sharing, matches, things like that. Benefit payments, vesting, safe harbors, other miscellaneous choices such as self-direction of investments, which nearly everybody chooses because it provides protection under 404C. Loans. We're seeing more employers no longer offering loans, which I don't think is necessarily a bad thing. Types of benefit payments get to be decided. Lump sum is the most common, but annuities and periodic payments can be added in. Periodic payments and also ad hoc. We didn't list it here, but we see ad hoc distributions being allowed. Sometimes employees want to continue to enjoy the investments in their plan after retirement, but they need to take their required minimum distributions. So, and maybe they want to take the required minimum distributions plus a little extra or something like that. So an ad hoc distribution benefit is often available. Vesting and timing of distributions, most often when an employee leaves retirement. Vesting schedules are interesting for employer contributions. You know, for years, and at the very beginning, it said that I've been doing this for over 30 years. I'm actually in my 40th year in this business now, and for many years, we either saw 100% immediate vesting or we saw a 6-year graded schedule. Actually, back in the day, before we were before some changes, we had 7-year vesting schedules. More often than not, now we're seeing shorter vesting schedules. We're seeing 3-year cliffs, and we're seeing 4-year graded, 25, 25, 25, and so on. So vesting schedules are changing a little bit. Safe harbor designs, as we're all aware, Safe Harbor came about as an easier way to pass ADP and ACP testing, simply a bypass on that testing. And so we are seeing more and more employers adopting safe harbor elections in order to not be bothered with certain compliance tests. Other miscellaneous provisions, participants may be permitted to self-direct investments. That's pretty common. Insurance may be allowed in the plans, rarely. Smaller plans, I would say. Stock of the employer, banking industry. We do a lot of work in the banking industry, so we see a lot of in banks. We see a lot of stock. Secure 2.0 optional provisions. Probably one of the most talked about optional provisions has to do with tying employee student loan repayments to the plan and providing matching contributions based on student loan repayments. So in other words, if I'm an employee who has a student loan, maybe I can't afford to defer enough to get the match, but because I'm making student loan repayments, we do see some employers now looking for that optional benefit that they can tie the two together. It's a little tricky yet. It's a year-end true-up contribution because it can't be tied real time. So if you're an employer who's making matching contributions every payroll cycle, and you want to look into student loan repayments being tied to matching contributions, those are going to have to be done as a year-end true-up, at least at this stage, because the record keepers that are out there, the Fidelities and the American Funds and the Empowers and the Nationwides and whomever principals, they are working on ways to tie that together on a real-time basis, but it doesn't exist just yet. Third polling question.
All right. True or false, plan sponsors can exclude certain employees from plan participation within limits. This poll will remain open for about 45 seconds. The poll will remain open for about 15 more seconds. Okay, the poll is now closed. The correct answer was A, true.
Thank you, Noel. So document changes can be initiated by plan sponsor or required by the IRS, or actually, again, Congress can dictate plan changes as well. Certain language is always required in the plan document. Plan provisions can be optional. Some are mandatory. The importance of keeping the plan document current is critical. One of the most common things for the audience, if you are a plan sponsor or working for a plan sponsor, one of the simplest things is go make sure your document's signed. I can't tell you how many I come across that are unsigned, and an unsigned document is an invalid document. Now the good news is, let me say it differently. The bad news was that used to be a formal voluntary correction procedure correction, if you will, with the IRS if you had an unsigned document. If you had an unsigned document that was found during an audit, it was call for disqualification and an audit closing program arrangement to keep the plan qualified. One of the great things about Secure 2.0 is Section 305 that lets us correct inadvertent errors like not signing a document through self-correction rather than formal process. So to all my SHRM folks who are employers or plan sponsors, go look at your document and see if it's signed. And if it's not signed, we can help you with the procedure for self-correcting that. Now we're going to talk about the types of plans. So again, today's lesson is about what makes a plan qualified. We've talked about IRS rules and document rules. Now we're going to talk about the types of plans that are available. Obviously, profit sharing plans, what are actually employer non-elective contributions, but the plans, the slang is profit sharing plans. Money purchase plans, see very few of those anymore, other than through union arrangements. 401k plans, most common that everybody's familiar with. Standard safe harbor 401k, automatic enrollment safe harbor, could be an ACA, an EACA, or QACA. So lots of different types there. Defined benefit plans and 403B plans. So we're going to talk briefly, at least, about each of these. So profit sharing plan. So what we're talking about here is just an employer contribution. Now, think of this as being an ERISA qualified SEP IRA. Okay, so if you're familiar with a SEP IRA, well, it used to be called a SAR-SEP, no longer available, salary reduction, single employer plans, or simplified employer plans. So a simplified employer plan is a plan that allows an employer to put money into it. A profit sharing plan is the same. Any employer, including sole proprietors, S corps, C corps, partnerships, nonprofit organizations. This is a 401A plan, and it's available to any type of employer, including governmental entities. Contributions up to 25% of compensation, the lesser of 100% of compensation per employee, or the limits set annually. Catch-up contributions are not applicable because this is not a 401k plan. No employee contributions can apply a 3-year or 6-year graded schedule. That's a top-heavy schedule. There are other vesting schedules that can be applied. These can be established by the later of an employer's tax filing deadline, including extension. So let's say it's an employer with a calendar year, fiscal year, so their business starts and ends every year on 1/1 and 12/31, and maybe they file an extension and they file their taxes by September 15th of the following year. Theoretically, they have until that date to set up and fund a profit sharing plan. We, Pentegra, require 60 days prior to that deadline to actually get the plan started to be set up. But you get the idea that you can literally, initially you can see how the business is going before you set the plan up and are required to fund it. A money purchase pension plan. So think of a money purchase pension plan as being similar to a profit sharing plan, but without discretionary contributions. The contributions are required. They are mandatory contributions as specified by the plan. So the limits are the same. Again, no catch-up. Similar vesting rules, but a money purchase plan requires mandatory annual contributions as defined by the retirement plan. The difference between a money purchase defined contribution plan and a defined benefit pension plan, however, is that typically participants still are responsible for their own investments or their own investment decisions. Or if it's a trust, the benefits at retirement, like a profit sharing plan, are equal to the contributions plus the gains or losses of the trust. Whereas in a defined benefit plan, which we'll talk about in a couple minutes, the benefits at retirement are defined by the document. So the document says each participant will receive X benefit by retirement. In a defined benefit plan. In a money purchase plan, the benefit will be simply the contributions plus any gains or losses. Deadline to establish, again, business tax filing deadline. And contribution deadline is the earlier of the business deadline, or the including extensions, but the final date, the minimum funding must be met by September 15th for calendar year plans. 401k plans, this is where you're everyone is most familiar with these. Sole proprietorships, S&C Corps, partnerships, nonprofit organizations. Governmental entities may not establish a 401k plan. 457 plans are available for employee deferrals for governmental entities. Elective salary deferral, so employees elect to contribute to these plans, save for new Secure 2.0 rules that would require an employer who has never had a 401k plan before and is setting up a new one for the first time and is not otherwise eligible for one of the exemptions, would require employees to enroll when they're hired. So historically, 401k plans have been voluntary plans. Employees volunteer to contribute. After Secure 2.0, if you are beginning January 1st, 2024, January 1st, 2025, if you are establishing a 401k plan for the first time, you are required to have an automatic enrollment feature, again, unless you meet other criteria. If you're a smaller employer, or if you're an employer that's only been in business for a year or something to that nature, there are exemptions to that rule. Otherwise, you're required. Employer contributions, again, same, up to 25%, matching or profit sharing contributions. Participant limit is 100% of compensation. And salary deferrals, not really sure what the immediate, vesting, I'm sorry, vesting. So yes, employees are always vested in what they put in their own, out of their own paycheck. Employer contributions can have a vesting schedule. The example we give here is a 3-year or 6-year, but there are other vesting schedules. Again, 4-year graded, 5-year graded, and so on. 401k plan deadlines, a little different, right? Because employees can't defer until the plan is set up and can't defer retroactively. So if we have if we're setting up a 401k plan, we don't have until an extended tax filing deadline next year to set one up for this year, because employees cannot defer from their paychecks in arrears. So there are rules for establishing 401k plans. If it's a safe harbor plan, generally by October 1st, we need employees to be able to have at least a few months to defer money into the plan. There are deposit requirements. When you are an employer and you are withholding money from an employee's paycheck, it has to be deposited by a specific date or deadline. Otherwise, it's a violation of ERISA. It's deemed to be a loan from the employee to the employer if the money is not deposited. So lots of different rules regarding that. Employers can still delay any employer contributions until a business tax filing deadline. So a match or a profit sharing contribution that's allocated annually to the plan can be delayed until a tax filing deadline in order to help the employer with their budgeting. A safe harbor plan. So 401k plans are tested for non-discrimination. The non-discrimination test is comparing the contributions and/or benefits of highly compensated employees to those of non-highly compensated employees. Highly compensated employees are always owners who own 5% or more of the company. Their family members who work for the company. It's non-owners over a certain income limit. So the idea here is that a plan cannot be set up solely to benefit owners and other highly compensated employees. And an employer might say to themselves, well, if I set up a plan and none of my employees choose to defer, isn't that their business? And why am I penalized by their lack of concern for their retirement? Because that's the way Congress wrote the rules beginning back in 1974. So what an owner defers out of their paycheck, what an owner might receive in a matching contribution. I'm going to use owner instead of highly compensated employee, or HCE as we refer to them, because we love our acronyms in the retirement plan business. What they receive in a match, what they receive in an employer profit sharing contribution, all of that is limited unless we have a safe harbor plan. And a safe harbor plan lets us bypass certain non-discrimination testing. And it's available to sole proprietorships, S&C Corps, partnerships, nonprofit organizations. And the first test, the actual deferral contribution test, the actual deferral percentage test, I should say, the ADP test, as we call it, is the first test, and it measures how much are the owners or other HCs putting in out of their paycheck versus how much is everybody else putting in out of their paycheck. And that test can be bypassed with a safe harbor election. The ACP test, the actual contribution percentage test, essentially tests matching contributions. So a safe harbor matching program, as outlined here, allows the plan to bypass that test. And it says, so the bypassing of these tests means that now the owner, if the owner contributes the maximum that they're allowed and they receive the maximum match that they're allowed, and none of the employees choose to put anything in, that's okay. The employees aren't getting the match, but that's still okay. The plan passes those tests. And if only the owners or other highly compensated or key employees, if you will, are contributing to the plan, then they're going to end up with most of the money in the plan. And if their account balances exceed 60% of the total accounts in the plan, then the plan is called top heavy. And top heavy isn't necessarily a bad thing, but again, if a plan is safe harbor, it has a top heavy exemption, so that's another good thing. One downside of safe harbor plans that some employers are concerned about is the vesting. It's immediate. So unless it's a certain type of safe harbor plan that does allow for a 2-year vesting schedule. So the deadline to establish generally prior to the beginning of the plan year in order to provide all the proper notices. So if you have a tested 401k plan now, we would start 60 days prior to the beginning of next year so that all the proper notices are available. There is language in Secure 2.0 that allows for the adoption of safe harbor mid-year, beginning in 2024. And we, Pentegra, we will be disseminating those rules in the near future and letting everybody know how they can take advantage of it. It's not uncommon for a tested 401k plan to look at their testing shortly after the beginning of the year and say, "Oh gosh, this is getting crazy. We keep having excess deferrals refunded to our highly compensated employees. Why don't we just make a safe harbor election?" Well, that'll be available beginning in 2024. Automatic enrollment safe harbor plans. Let me just go back. Yes, that's standard. So automatic enrollment safe harbor plans. These combine safe harbor with that automatic enrollment feature that I mentioned previously. So while automatic enrollment is not required for existing plans, unless they're joining a multiple employer plan after the enactment of Secure 2.0, it is required for employers adopting a 401k plan for the first time after the enactment of Secure 2.0. And that can be coupled with a safe harbor provision. And that often then kind of satisfies all different rules, if you will, by combining the two. So we satisfy safe harbor, and we satisfy that rule, or we don't have to worry about whether an employee is or is not going to enroll in the plan. We just simply automatically enroll them, and they always have the option to opt out. By the way, I should mention that when we're talking about automatic enrollment features, employees are always able to opt out. But under those new rules, if they apply, they are automatically enrolled. So we have required employer contributions, either matching or non-elective. Catch-up is available for the over age 50. Vesting, we can allow up to a 2-year vesting schedule. So remember a few slides ago, safe harbor is historically, safe harbor contributions are automatically vested. So if it's a basic safe harbor match, or let's say if it's a 3% employer non-elective contribution, those are 100% vested. This qualified automatic contribution arrangement, or QACA as we call it, it can allow up to a 2-year vesting schedule. And we have contribution deadlines similar to any other plan, either the 7 business days for small plans or no later than the 15th day of the month following for larger plans, for audited plans. Defined benefit plans, again, we're not going to spend a lot of time on these. Traditional pension plans, we do still see a fair amount of business in defined benefit plans, but not in traditional defined benefit pension plans. More so in what are called cash balance pension plans, and more often than not, we see those for smaller employers, where an owner is taking advantage of the fact that benefits can be quite substantial to an owner in a cash balance plan, with relatively modest contributions to all other employees. These are tax leveraged plans that allow business owners to contribute large sums to retirement. They're still required to make contributions to employees. I kind of put it this way: if you are a business with, say, less than 50 employees, and if you're looking for large contributions to retirement, and if you're comfortable making contributions, say in the 7 to 10% range for most of your employees, then as a business owner, you can have contributions oftentimes well exceeding your compensation to a cash balance pension plan. Not uncommon for, say, a 50-year-old business owner paying themselves $150,000 a year to be able to contribute several $100,000 per year into the cash balance plan for themselves, still having to contribute something to employees, but large contributions that are dedicated to their own benefit. Catch-up contributions don't apply, except that with a cash balance pension plan, we often tie a 401k profit sharing plan to it. In fact, we always do, because the two work hand in hand together. A cash balance plan on its own will struggle to pass non-discrimination testing without a defined contribution plan tied to it. And so that there, with the 401k plan tied to it, there is option for catch-up contributions. 403b plans. So 403b plans are for 501c3 organizations. So you can think of private K through 12, private higher education, or philanthropic organizations. United Way in most cities and towns across the country, other 501c3 organizations. There are often many of these locally, and they can have a 403b plan, and the 403b plan allows for employee deferrals, just like 401k plans do. They allow for catch-up contributions. They allow for employer contributions. Unlike 401k plans, they are not subject to that ADP test, to that actual deferral percentage test. A 501c3 organization that has a highly compensated employee who wants to contribute as much as possible to their elective deferrals is not in any way hindered by the lack of deferrals of others in that organization. Vesting, same vesting schedules are typically available. In education, we most often see 100% immediate vesting. We rarely see vesting schedules for the employer contribution. Occasionally they occur, but most often we see 100% immediate vesting for 403b plans. Deadline to establish business tax year end, but again, has to be earlier to take advantage of deferrals, because deferrals cannot be withheld from pay in arrears. Contribution deadline similar to 401k plans. Smaller employers, if you have a community theater with 20 employees, versus a private college or university that has 400 or 500 employees, different rules regarding contribution timing. The last polling question, everybody.
Okay, which of the following types of business can establish a 401k plan? This poll will be open for about 45 seconds. The poll will be open for another 15 seconds. Okay, the poll is now closed. The correct answer was E, B, and C.
Thank you, Noel. So we have different retirement plan limits for 2023 and 2024. And just to go through them briefly, elective deferral limits. So elective deferrals, elective means choice. Deferral indicates that it's coming from an employee's paycheck. They are deferring out of their pay. They are electing to defer. And even, by the way, even when we're talking about automatic contribution arrangements, because the employee has the option or has the ability to opt out of an automatic contribution arrangement, We still refer to those as elective deferrals because, again, they still have the ability to make a choice. This year it was $22,500, $7,500 catch up. Our annual defined benefit limit is $265,000. Annual defined contribution limit was $66,000. So on and so forth. I won't read through them all. Our compensation limit for 2023 was $330,000. Simples were $15,500, and so on. And for 2024, as occurs typically, well, we get a cost of living increase for certain things at the very least. So we got a cost of living increase for elective deferrals. We did not get one for catch-up contributions. Catch-up contributions next year are the same as this year, as 2023. The annual defined benefit limit goes up. Annual DC limit goes up slightly. Compensation limits go up that we're using or that we're able to use for calculations. Highly compensated employee threshold goes up. Remember, that's a look back test. So when we're determining who's an HCE, I said at the very beginning that highly compensated employees are always 5% or more owners. Immediate family members who work for the employer of 5% or more owners. Non-owners who earn over a certain compensation limit. And so for 2024, we look back to 2023 and we say, who earned more than who earned more than $155,000 in 2023? They are a highly compensated employee in 2024. Quick side note, sometimes people hire new people in 2024 that are making over that limit, and they ask, are they a highly compensated employee? And the answer is no, because they weren't employed by the sponsor in the prior year. Therefore, they have no prior year income. So it's only income from the sponsor. That's a concern. All the rest of the limits pretty self-explanatory there. So in summary, there are different types of qualified plans: profit sharing plans, 401k plans, 403b plans, defined benefit plans. There are lots of available plan features. Some are required. There are minimum participation rules. In some plans, there are minimum funding rules. In some plans, there are no annual funding requirements. In other plans, there are mandatory annual funding requirements. And it just depends on what best suits each employer. There are maximum contribution limits. We said that ERISA qualified plans are all established under a written instrument. The written instrument has to be kept up to date. It has to be signed. Certain information has to be distributed on a periodic basis to not only employees, eligible employees, but actual participants, beneficiaries in some cases of those participants, alternate payees in some cases of those participants, and so all very complicated stuff. And everything that we've talked about today is the role of the plan administrator by and large. So again, if you think about how plans are established, you have a business owner. They choose to establish a plan that makes them the plan sponsor. In many cases, they are also then immediately the plan administrator and the trustee, and they are the investment manager. Now, they can delegate their plan administration responsibilities to another fiduciary, to a 316 fiduciary. Simply hiring a TPA does not make them a 316 fiduciary. You have to specifically hire a firm that serves as a 316 fiduciary. You can also delegate your investment management responsibilities to an investment manager under ERISA 338. So we typically refer to 316 administrators and 338 investment managers in the business. And in most instances, most of the larger custodial companies, I mentioned Fidelity, Nationwide, Empower, Principal, most all have trust services as well. So the role of a directed trustee can be outsourced. So having a plan remain qualified is very important to your employees and requires requires prudent fiduciary services. And as an employer, if you're not comfortable doing those things yourself, if you don't want to be a knowledgeable and prudent fiduciary regarding all of the rules, if you take a look at a typical plan document, not the adoption agreement, but a typical plan document, we've talked about this, the written instrument, it's roughly 120 pages, and it mentions the plan administrator about 300 times. So if you're a business owner and if you're not interested in learning each of those 300 or more chores that you are required to be a prudent fiduciary for, then you should look into outsourcing not just the administrative services, but the administrative liability as well. So one quick commercial, that's what we here at Pentegra have been doing for 80 years. 80 years as of last week. December 1st was our 80th birthday. Thanks for joining us. Don't hang up yet. You have to stay for a few more minutes. I'm going to turn it back over to Noel here in a second. This is my last session of the year. I will probably have somewhere between 4 and 6 sessions next year. Others at Pentegra will also be doing those. I hope you join us for those. Noel, take it away.
We actually do have time for one question, and a few came in, if you don't mind, Dave.
Sure.
Somebody did ask what types of plans are required to file a Form 5500.
So any ERISA plan is required to file a Form 5500. So it might be easier to think, what's a non-ERISA plan? Well, a non-ERISA plan is a simple IRA. A non-ERISA plan is a SEP, a Simplified Employer Pension Plan. Those don't file 5500s. If you're in the nonprofit world, 457 plans do not file, or governmental entity, 457 plans do not file 5500s. All of the rest of them, profit sharing plans, 401k plans, 403b plans, defined benefit pension plans, cash balance pension plans, all file Form 5500s.
Okay, we have another. We have starting with January 1st, 2025, there will be an automatic enrollment requirement in new 401k plans. Can employees still opt out of automatic enrollment if they can currently?
Yes, absolutely. Secure 2.0 allows for employees to opt out. I will mention that on the horizon, and the horizon is long, it's probably at least 3 to 5 years down the road, I have seen draft language as part of the Government Affairs Committee for American Society of Pension Professionals and Actuaries. I have seen draft language of Secure 3.0. And in Secure 3.0, one of the ideas being put forth is a mandatory re-enrollment of everybody every 3 years. So the idea, so currently, Secure 2.0 allows for every employee to opt out. It's called making an affirmative election. You can make an affirmative election to say, I want to put in 0, or I want to put in anything other than the mandatory, or the not mandatory, the automatic election. And that affirmative election takes you out of it.
Okay. Well, it looks like we are at 3 o'clock. So I want to say thank you, Dave, and thank you to everyone for attending today's webinar. Any questions that we did not get to today, we will follow up with you separately. And as a reminder, please complete the survey questions that will pop up on your screen in just a minute. And everyone have a great rest of your day. Thanks for joining us.
Thank you.